Hello students, welcome you all back to our advanced accounting session. Last two units we have completed. Unit number 1 we have done partnership accounts 1. In unit number 2 we have done partnership accounts 2. So we have seen how the accounts are maintained in partnership. Now in unit number 3 we are concerned with company accounts. We will study about company accounts. So in this unit we are going to cover up issue of shares, issue of debentures, underwriting and bonus shares. These 4 topics we have in this unit. Before starting the main issue of shares and issue of debentures, we must know what do you mean by joint stock company? What are the features of joint stock company? What are the different types of companies? What are shares? What are the different classes of shares? All these things we must know before starting the concept of issue of shares. First we'll discuss about a joint stock company. It's a form of business organization. There are different types of business organization. The oldest and the more popular form of business organization is sole trading concern. A single person apply his own funds, his own skill. He will manage the complete business. He will control the business. He will take all decisions. He will get all profit. He will bear all losses. That is the oldest form of business organization, still prevailing. But there are many limitations of sole trading concern. It can be conducted only on small scale, catering to the local area. A single person cannot bring much capital and other resources. He don't have so much of capability of managing each and everything. It will be difficult. So due to a number of limitations, the next type of business organization was started, and that was partnership. 2 or more firms come together, jointly contribute the funds, manage jointly the activities of the business, control the business, takes the decisions jointly, and they will share the profits of the business according to the profit sharing ratio. This is called partnership business. It is compared to sole trading concern, partnership business has a little bit advantages. Large capital can be pooled, then activities can be managed properly because there is diversification, specialization. So each of the partner can deal with one activity. So this specialization can be brought up. So these are the some advantages. But disadvantages are, again, there is a limit on partnership. We cannot make any number of partners in a partnership firm. The law has given some limit. So within that limit, a partnership firm can operate. Secondly, the liability of partners are unlimited. The liability is unlimited. Not only the personal asset, but also the business assets are liable to pay the debts of the business. So that will be a problem. So to overcome the problems of partnership, the new commonly found business is joint stock company. Throughout the world, this form of business organization is very, very important. So what is a joint stock company? Meaning of joint stock company. A joint stock company is an artificial person created by law, invisible, intangible, existing only in the contemplation of law. According to Indian Companies Act 2013, a joint stock company is a company which is formed and registered under this act, or an existing company. Existing company means any company which was formed and registered in former Companies Acts. Former Companies Acts. That is called a joint stock company. Simply we can say a joint stock company is an artificial person created by law. It exists in the eyes of law as an artificial person. So that is the meaning of the term joint stock company. Now we'll come to the features of joint stock company. So it has distinctive features. The first feature of joint stock company is voluntary association. It is not a compulsory association. The association is not made with compulsion or mandatory like that. Voluntarily, few persons can come together to start a business in the form of joint stock company. They can register with the law, then company can come into existence. So it is voluntary. no compulsion, no mandatory. The next one is separate legal existence. A company is a separate legal entity compared to their owners. So, a joint stock company can hold the property, can purchase the property, can sell the property in its own name. In its own name. So it has a separate entity. The only thing is we are natural person, a company is an artificial person. Just like we can purchase the property, we can sell the property in our name. So a company can also purchase the property, sell the property, enter into number of contracts in its own name. So it has a separate legal existence. From legal point of view, from law, a company is a separate person. Next is perpetual existence. Perpetual means continuous. The life of the company does not depend on the life of the members. The members may come and go. Even if one of the members has become insolvent or lunatic or bankrupt, then nothing will happen to the company. The company can go forever. That means the life will not be affected due to the lives of the members. Members may come and go, but the company will go forever. Perpetual existence. Next is limited liability. Normally, the liability of the shareholder is limited to the extent of amount unpaid on the share capital. So a person's liability is not more than the paid up, the face value of the shares which he hold. For example, if a person is holding 1 lakh rupees worth of shares, already he has paid 60,000 to the company, has paid up capital. 40,000 rupees he has not paid, so his liability is only up to 40,000. His personal assets are not liable to pay the debts of the company. His personal assets are intact. That is the advantage from the investor's point of view. So limited liability. The liability of shareholder is limited to the extent of unpaid amount on his shares. Beyond that, his personal assets are not liable to pay the debts of the company. Transferability of shares. Normally, the shares of a company are freely transferable from one person to another person. It's a negotiable instrument, except the shares of a private company. The private company shares are not freely transferable. Public company shares are freely transferable. If a person is holding the share, at any time he can sell the shares to another person. Common seal. Every joint stock company must have a common seal. It is just a signature of the company. A natural person can enter into a contract by signing the agreement. When he puts an agreement signature, there is a binding contract between two parties. Similarly, a company is an artificial person. The company will function through board of directors. The board of directors make all the contracts and all the negotiations, all the activities board of directors will make on behalf of company. On behalf of company. Say they will put the common seal of the company. So whichever document, whichever contract has common seal, that means the company has entered into a contract. Next is separation of ownership and management. In joint stock company, the owners are the shareholders. They have subscribed to the share capital of the company. They are the owners. They will get the profit from the company. But the management of the company is in the hands of board of directors. They are the representative shareholders. The shareholders will elect some of the shareholders among themselves as board of directors. The board of directors will manage the company. So management is in the hands of board of directors, whereas the owners are the shareholders. Shareholders are scattered throughout the length and breadth of the company, whereas management of the company is at one place, where board of directors will control, manage the activities of business. Next one is number of members. See, for a public limited company, the minimum number of members are 7 and the maximum number of members in a public limited company is unlimited. Infinity. There is no limit at all. Maximum number of members in a public limited company. Minimum 7. Whereas in a private limited company, minimum number of members are 2. And the maximum number of members in a private limited company is 200. So minimum 2, maximum 200. Not more than 200. for a private company. These are the number of members. Formation and liquidation. To form a joint stock company, incorporation is must. Without incorporation, no company can be formed. Incorporation means registration. Registration of a company is a must under the Companies Act, under any law. So there is a procedure how to incorporate a joint stock company. So we have to follow the step-by-step procedure of incorporation, then only the company will come into existence. So there is a procedure, there is a law for incorporating a company. Similarly, there is a procedure for liquidation. If the company wants to be liquidated, wound up, then again procedure is there how to wind up a company, given in the Companies Act 2013. So these are some of the features of a joint stock company. Now we'll discuss about kinds of companies. Different types of companies are there. The first type of company is company limited by shares. The company limited by shares are those companies where the liability of the shareholder is limited to the extent of any unpaid amount on his share capital. So beyond that, he is not liable to pay anything. So most of the companies are these companies limited by shares, where the liability of the shareholders is limited to the extent of unpaid amount on the capital. Apart from that, the shareholder's personal property is not liable to pay the debts of the company. Companies limited by guarantee. These are those companies where the members will guarantee that we will pay a certain amount of money on the happening of the event. The event is wind up. When the company is wound up, then we agree, we promise, we guarantee that we will pay so and so amount, we will contribute to so and so amount to the capital of the company. So these are called companies limited by guarantee. But normally these companies are made not to earn the profit. But the companies which are limited by guarantee are formed for promoting art, science, culture, etc., charity, etc. For these purposes, for non-economic purpose, for non-business purpose, not to earn the profit, but to promote the art, science, culture, charity, etc. These companies are made where the members will guarantee that we will contribute so and so amount on the happening of the event is winding up. Next comes unlimited companies. Those companies where the liability of the members are unlimited. Normally this type of companies are not there, but theoretically we have to we should know that unlimited companies are those companies where the liability of shareholders is unlimited, just like a sole trader or a partner. Next comes foreign company. A company which is formed and incorporated outside India but having a place of business in India. Having some business activity in India, but the company was incorporated, formed outside India. It is called foreign company. Government company, a company in which not less than 51% of its paid up capital is held by the state, by the central government or state government or both. So any company not less than 51% of paid up capital is held by the central government or state government or both. That is called a government company. Next comes one-person company. A company in which only one person is the member. That is called one-person company. Next comes statutory company. A company which is formed by passing a special act in the parliament or in the state legislature. So a company which is formed by passing a special act in the parliament or in the state legislature, it is called statutory company. Example of statutory company are RBI, Reserve Bank of India, LIC, Life Insurance Corporation, etc. These are the companies, statutory company. Private company, a company which by its articles restricts, limits, prohibits. First, restricts. A company through its articles will restrict the transferability of shares. Restrict the transferability of shares means the company's shares are not transferable. Restriction there. Second, limits. Limits the number of members to 200, not more than 200. Limits the number of members to 200. Third, prohibits an invitation to the public to subscribe the shares. This company will prohibit, private company will prohibit invitation to the public to come and subscribe for the shares. If these three words are there, it is called a private company. Restricts, limits, prohibits. Restricts the transferability of shares, limits the number of members to 200, and prohibits an invitation to the public to come and subscribe to the shares of the company. अगर ये तीन कंडीशंस हैं तो वो कंपनी को कहते हैं प्राइवेट कंपनी. अगर ये तीन में से एक भी कंडीशन सैटिस्फाई नहीं होगा तो वो कंपनी पब्लिक कंपनी बन जाएगी. नेक्स्ट कम्स पब्लिक कंपनी. Any company which is not a private company or a company whose capital is more than 5 lakh, whose paid up capital is more than 5 lakh, that company is called a public company. Small company. A company whose paid up capital is less than 50 lakh and its turnover is less than 2 crore. अगर 2 crore से कम टर्नओवर हो रहा, उसका सेल हो रहा और उसका पेड अप कैपिटल 50 लाख से कम है तो इट इज कॉल्ड ए स्मॉल कंपनी. नेक्स्ट कम लिस्टेड कंपनी. ए कंपनी हुज सिक्योरिटीज आर लिस्टेड इन अ स्टॉक एक्सचेंज, दैट कंपनी इज कॉल्ड ए लिस्टेड कंपनी. Only listed companies shares will be traded in a stock exchange. Every company's shares will not be traded in the stock exchange. हर कंपनी के शेयर्स मार्केट में नहीं बिकते, स्टॉक एक्सचेंज में नहीं बिकते. जो कंपनी की लिस्टिंग हुई है वही कंपनी के शेयर्स मार्केट में बिकेंगे. दैट इज लिस्टेड कंपनी. नाउ क्लासेस ऑफ शेयर्स. Broadly we have two classes of shares. Actually before that we will study what do you mean by shares. The capital of a joint stock company is divided into a number of small units or denominations. So each such denomination of the total share capital of the company is called a share. For example, if a company is having the total capital, share capital of rupees 50 lakh and this consists of 5 lakh shares of rupees 10 each. So 50 lakh rupees total capital. This total capital of 50 lakh consists of 5 lakh shares of rupees 10 each. So this 10 rupees is called share face value. Right? Now, there are two types. According to Companies Act, two types of shares are there. That is preference shares and equity shares. The preference shares are those shares which carry two preferential rights. The two preferential rights are, the first right is the preference shareholders will get a fixed rate of dividend before any dividend is paid to equity shareholders. कंपनी जब भी डिविडेंड पे करना है पहले प्रेफरेंस शेयर होल्डर्स को पे करना, उसके बाद पैसा बचा तो इक्विटी को जाएगा वरना नहीं जाएगा. तो प्रेफरेंस शेयर होल्डर्स विल हैव ए प्रेफरेंशियल राइट टू गेट अ फिक्स्ड रेट ऑफ डिविडेंड. फर्स्ट राइट. Second preferential right, at the time of winding up of the company, the preference shareholders will have a preference to get back their capital before any capital is paid to equity shareholders. तो वाइंड अप के टाइम पर जब कंपनी लिक्विडेट हो रही, खत्म हो जा रही, तो पहले प्रेफरेंस कैपिटल वापस करना, उसके बाद पैसा बचा तो इक्विटी वरना नहीं. तो if any shares, if these two rights are carried, then that shares are called preference shares. Preference to get dividend before paying any dividend to the equity. Preference to get back the share capital at the time of winding up before any capital is paid to equity shareholders. These are called preference shares. So we have completed up to this part. We have seen what is meant by company, what are the features of joint stock company. We have discussed about what are the different types of companies. We have discussed about the classes of shares. And in the next session, in the next video, we will discuss about what are the different types of preference shares. What are the different types of preference shares and what is the presentation of information relating to share capital in a joint stock company. In a joint stock company में शेयर कैपिटल को कैसा प्रेजेंट करेंगे बैलेंस शीट में, उसका मेथड दिया है, उसका एक्सप्लेनेशन क्या चीज चाहिए अकॉर्डिंग टू कंपनीज एक्ट, दैट विल डिस्कस. देन वी डिस्कस अबाउट द जर्नल एंट्रीज ऑन इश्यू ऑफ शेयर्स. When shares are issued, what are the journal entries? That we'll discuss in the next session.